If I told you that a company started the year with $100,000 in cash and ended the year with only $10,000 in cash, could you make any predictions about how this change might affect the company? Many people might assume that such a large decrease in cash must be a negative thing. But without more details, how can we really be sure? What caused the cash balance to fall so much? Have sales been rapidly declining, leading the company to have issues paying their debts? Was $100,000 too much money to have sitting around, leading the company to invest the unused cash? Was cash used to purchase new, more efficient machinery that will improve profitability for several years to come? If you only knew the cash amounts, you wouldn't be able to answer any of these questions. But if you had more details about how the company's cash changed throughout the year, you would be able to say a lot more about how the change in cash might positively or negatively affect the company. The statement of cash flows is a financial statement which lists the details of exactly how cash changed from the beginning to the end of a period. The statement of cash flows has three main sections called the operating, investing, and financing sections. The first section lists changes to cash related to operating activities. Operating activities are activities that determine a company's net income. A few examples include cash received from sales to customers, collections from credit sales, interest, cash dividends, or cash paid for employee salaries, inventory, taxes, or interest. There are two different ways to complete the operating section of the statement of cash flows. The direct method separately lists each item of operating cash receipt or payment. The indirect method starts with net income, which is then adjusted to reach cash flow from operating activities. The indirect method is by far the more common form for the operating section of the statement of cash flows, and will be covered in more detail in the next video. The second section of the statement of cash flows is for investing activities. This section is generally related to long-term assets. Examples include the purchase or sale of long-term assets like machinery, equipment, land, or buildings, the collection of the principal on notes receivable, cash loaned in return for notes receivable. Generally, all activities related to long-term assets are reported on the investing section of the statement of cash flows, but there are a few important exceptions. First, lending and receiving cash related to short-term notes receivable should still be reported on the investing section of the statement of cash flows, despite being short-term. The purchase or sale of short-term investments should be reported on the investing section of the statement of cash flows, despite being short-term, as long as they aren't trading securities, which should be reported on the operating section. Interest on notes receivable, regardless of if the note is short or long-term, is never reported on the investing section of the statement of cash flows, but instead should be reported on the operating section, as we noted earlier. The third section of the statement of cash flows is for financing activities. This section generally lists changes in cash related to long-term liabilities and equity. Examples include issuing stock for cash, payment of cash dividends, cash received from debt obligations such as notes payable or bonds payable, the purchase or sale of treasury stock. Exceptions to the long-term liability classification for the financing section of the statement of cash flows are similar to the exceptions we had with the investing section. One such exception is cash borrowed or principal paid on short-term notes payable, which should still be reported on the financing section of the statement of cash flows despite being short-term. Interest paid on notes payable, regardless of if the note is short or long-term, is never reported on the financing section of the statement of cash flows, but instead should be reported on the operating section, as we noted earlier. There are some important investing and financing activities that do not affect the cash account. We call these transactions non-cash investing and financing transactions, and they must be disclosed at the bottom of the statement of cash flows, or in a note along with the statement of cash flows. Examples of non-cash investing and financing transactions include purchasing assets by issuance of a note or bond, the purchase of assets by issuing stock, an exchange of one asset for another asset, such as exchanging one piece of equipment for a different piece of equipment, and the conversion of preferred to common stock. So here we have an example of the statement of cash flows. So we have the first section, which is cash from operating activities, and we know this is the indirect method because we start with net income, have a bunch of changes to that number, and then we're left with the net cash provided by operating activities, which ends up being $88,000 when we add and subtract all of these numbers. Then we have cash from investing activities, the second section. Looks like we both purchased and sold some equipment, and the net of that comes out to negative $75,000. Now, a quick note on the labeling here. Notice that we said that we have net cash provided by operating activities when we had a positive number here, and we have net cash used by investing activities down here when we have a negative number. That is always going to be the case. So use the word used when you have a negative cash flow, and use the word provided when you have a positive cash flow. Next, we have the third section, which is cash from financing activities. Looks like we issued some common stock, paid off some bonds, and also paid some dividends, leaving us with negative $6,000 for our cash flow from financing activities. Now, when you're all said and done with the three main sections, you're going to add those three numbers together. So we have 88,000 minus 75,000 minus 6,000 gives you a net increase in cash of $7,000. And then usually at the end here, you will put the cash balance as of the prior year end, and you would just get that from the balance sheet. And then the cash balance from the current year end also would come from the balance sheet. And if you've done everything right, then the difference between these numbers should be the same as your net increase or possibly decrease in cash. And we can see that that's the case here. 38,000 minus 31,000 is indeed $7,000. It looks like there were no non-cash investing or financing activities, because if there were, we would see those listed at the end of the statement of cash flows. Alright, that just about completes our introduction to the statement of cash flows. Make sure to watch the next few videos to learn how to complete each of the individual sections of the statement of cash flows.